Ever looked at a medical bill and felt like you'd just been hit by a truck? One bill, $15,000, gone, just like that. Now here's the kicker. Over 60% of bankruptcies in the US are tied to medical debt. That's not just a stat, that's people's lives turned upside down. But here's something most people don't know. There's a legal tax loophole that could put thousands of dollars back in your pocket. I'm serious. Today I'm sharing the exact tax strategy that saved my own family over $4,000 last year alone. And no, you don't have to be rich to use it. The financial burden of healthcare affects nearly everyone. In this video, we're covering a little-known tax trick that allows you to reduce your taxable income using medical expenses. If you're retired, self-employed, or dealing with major medical bills, this could be a financial lifesaver. We're talking about a little-known tax move that lets you cut your taxable income by using something you're already paying for, your medical expenses. By the time we're done, you'll have a clear plan to save thousands. Stick around to the end because I'm walking you through a real-life example that shows just how powerful this strategy can be. And here's the best part. This isn't insider info for accountants or CEOs. This is for anyone who's ever had to pay out of pocket for a doctor's visit. Let's dive into our first strategy, medical expense deductions. Many Americans don't realize they can deduct qualifying medical expenses that exceed 7.5% of their adjusted gross income. Here's what that means in real terms. If your adjusted gross income is $60,000, you can deduct every dollar you spend on qualifying medical expenses beyond $4,500. But here's where most people miss out. They don't know what qualifies. It's not just doctor visits and prescriptions. You can deduct things like mileage, driving to medical appointments, home modifications for medical needs, certain air purifiers, even swimming pools if prescribed for specific conditions. According to the IRS publication 502, the list of qualifying expenses is surprisingly extensive, and a recent tax court case actually expanded these eligible expenses even further. But here's the golden rule. Document everything. Keep every single receipt. Even that $12 prescription from January could be part of your deduction. Create a simple folder or use a tracking app to store all medical expenses throughout the year. Trust me, your future self will thank you when tax season arrives. Let me show you how this works with a real example. Meet Sarah, a marketing manager earning $70,000 annually. Last year she had unexpected dental work and a minor surgery, totaling $15,000 in medical expenses. Her threshold is 7.5% of her income, which is $5,250. This means she can deduct $9,150 of those expenses, saving her approximately $2,145 on her tax bill at the 22% tax bracket. That's real money back in her pocket that most Americans leave on the table every year. And if you want a complete list of what qualifies, check out IRS Publication 502. It's surprisingly readable, well, for government standards. Now let's talk about what might be the most powerful tax advantage in the entire tax code: health savings accounts, or HSAs. If you've never heard of it, you're not alone. But it's one of the only financial accounts in America with what's called a triple tax benefit. Here's how it works. First, the money you contribute into the HSA is tax-free, reducing your taxable income immediately. Second, that money grows tax-free through investments. And third, this is the amazing part, you withdraw it completely tax-free when used for medical expenses. No other account in our tax system offers this triple benefit. To qualify for an HSA, you need a high-deductible health plan. For 2025, that means a plan with a deductible of at least $1,600 for individuals or $3,200 for families. If you qualify, you can contribute up to $4,150 as an individual or $8,300 for families. And if you're 55 or older, you get an additional $1,000 catch-up contribution. The long-term impact of HSAs can be life-changing. Let me show you. If James, a 40-year-old software developer, contributes $3,000 annually to his HSA for 20 years, with a conservative 7% average return, he'll have over $123,000 for medical expenses in retirement, completely tax-free. According to Fidelity Research, the average couple retiring today needs approximately $315,000 saved just for healthcare costs, making this strategy absolutely essential. The smartest HSA users don't spend money from their HSA in the short term. Instead, they invest those funds for long-term growth, similar to a retirement account. Most HSA providers now offer investment options beyond just cash savings. As your balance grows, consider shifting from cash to a diversified portfolio based on your age and risk tolerance. If HSAs are the premium option, flexible spending accounts or FSAs are still valuable players in your medical tax strategy. FSAs are employer-offered plans that allow you to set aside pre-tax dollars for medical expenses. For 2025, you can contribute up to $3,200 to an FSA. Many people avoid FSAs because of the infamous use it or lose it rule. Unlike HSAs, traditional FSAs generally require you to spend the money within the plan year. But here's what most people don't know. Many employers offer either a grace period of up to 2 months, or allow you to roll over up to $610 to the following year. Check with your HR department about which option your plan offers. Let me share a smart FSA strategy. Mark, a teacher in Colorado, knew he needed new glasses and dental work in the upcoming year. By front-loading his FSA in January through payroll deductions, he paid for $2,800 in expenses pre-tax, even though he hadn't contributed the full amount yet. This is a little-known FSA perk. You can access your full annual election on day one of the plan year, essentially getting an interest-free loan while saving on taxes. Some employers even offer limited-purpose FSAs that work alongside HSAs, covering just dental and vision expenses. This lets you maximize both accounts simultaneously. According to recent research, Americans forfeit an estimated $400 million in FSA funds annually simply because they don't plan properly. Don't let your hard-earned money vanish. With a little planning, FSAs can save you hundreds or even thousands each year. Now, let's talk about a strategy that can turn your medical deductions from useless to powerful in a single year: strategic medical expense bunching. This approach is particularly valuable since the Tax Cuts and Jobs Act increased the standard deduction, making it harder for medical expenses to provide tax benefits. Bunching means concentrating your medical procedures in certain tax years to maximize deductions. Here's how it works. If your medical expenses typically don't exceed the 7.5% AGI threshold, consider scheduling discretionary medical procedures in the same tax year. By alternating 1 year with many medical expenses where you itemize, followed by a year where you take the standard deduction, you can significantly increase your tax savings. Think strategically about timing. December and January offer interesting planning opportunities. For example, if you're close to the threshold in December, scheduling procedures then rather than waiting until January could make those expenses deductible. Let me show you how powerful this can be. Lisa, a small business owner, needed 2 non-urgent procedures costing $6,000 each. Instead of doing one each year, she scheduled both in December, pushing her over the 7.5% AGI threshold and saving $3,200 in taxes. That's money she would have completely missed without this timing strategy. According to a 2024 analysis of tax court rulings, bunching strategies are completely legitimate tax planning approaches when done properly. Just remember that while you can prepay some medical expenses, the IRS has specific rules about which prepaid expenses qualify for deduction, so timing is everything. If you're self-employed, I've got great news. You have access to what might be the simplest yet most overlooked medical tax break, the self-employed health insurance deduction. Unlike regular medical expense deductions, this is an above-the-line deduction, meaning you don't need to itemize to claim it. For qualifying self-employed individuals, you can deduct 100% of your health, dental, and qualified long-term care insurance premiums for yourself, your spouse, and your dependents. This deduction directly reduces your adjusted gross income, which can make you eligible for other tax benefits that phase out at higher income levels. To qualify, your business must show a profit for the year, and you can't be eligible for coverage through your spouse's employer. Let me break down the impact with a real example. Carlos runs a small consulting business earning $85,000 in profit. He pays $14,000 annually for family health insurance. This entire amount is deductible above the line, saving him approximately $3,080 at the 22% tax bracket, without itemizing a single deduction. The contrast with employee health insurance is stark. Employees typically pay their portion of health insurance with after-tax dollars, unless they have access to a Section 125 cafeteria plan. According to recent IRS data, nearly 35% of self-employed taxpayers who qualify for this deduction fail to claim it, leaving thousands of dollars on the table each year. Now for the powerful finale, combining these strategies for maximum impact. I call this the full medical tax strategy, and it works by layering these tax benefits in the right order. Here's the optimal sequence. First, maximize HSA contributions for the triple tax benefit. Second, use FSA funds for additional expenses if available. Third, time your remaining medical expenses strategically using the bunching approach. And finally, deduct qualifying expenses above the 7.5% threshold. For self-employed individuals, claim the self-employed health insurance deduction first, then apply the remaining strategies to other medical expenses. The impact varies by income level, but a middle-class family implementing all these strategies properly could potentially reduce their effective medical costs by 30–40%. Let me share a real-life example that brings this all together. The Wilson family, a household earning $110,000 with 2 children, was spending roughly $18,500 annually on medical costs. By implementing all these strategies together, maximizing their HSA, using an FSA for childcare, bunching their elective procedures, and carefully documenting all expenses, they reduced their effective medical costs by 42%, saving $7,800 in a single year. What's particularly interesting is how their tax return changed. Before implementing these strategies, the Wilsons were taking the standard deduction and missing out on tax savings. After proper planning, they alternated years between itemizing and taking the standard deduction. Their HSA grew substantially, and their taxable income decreased significantly. Recent tax law changes have actually made these combination strategies more valuable than ever before. According to the IRS's own statistics, less than 10% of taxpayers are utilizing all available medical tax strategies, despite the potential for thousands in savings. Let's recap what we've covered tonight. We've explored 5 powerful tax strategies that can dramatically reduce your medical costs: medical expense deductions, health savings accounts, flexible spending accounts, strategic medical expense bunching, and the self-employed health insurance deduction. Remember, proper documentation is absolutely critical. Without it, these strategies are worthless, and timing matters too. When you approach year-end, that is the perfect time to implement these strategies before the tax year closes. Of the strategies we've covered, HSAs offer the biggest long-term benefit, while bunching provides the largest immediate savings for those with significant medical expenses. One final tip before we part ways. If you purchase health insurance through the marketplace, don't overlook premium tax credits. These credits can substantially reduce your monthly premiums based on your income level, and many middle-class families qualify without realizing it. We'll do a deep dive on this topic in an upcoming video, but I'll leave you with this shocking statistic. Americans leave over $1 billion in medical tax savings unclaimed every year. Don't be one of them. Your financial health is just as important as your physical health. This is Jennifer Williams, reporting on your financial wellness. This information only helps if you act on it. If you found this report valuable, please subscribe to our channel for more financial insights that could save you thousands. Do you have questions about specific medical expenses or situations? Drop them in the comments. And if you know someone struggling with medical bills, sharing this video could literally save them thousands of dollars. Before you go, here's a teaser. In a future video, I'll be revealing how to legally write off your family vacation. Yes, you read that correctly. It's another tax strategy that most Americans have no idea exists. Thanks for watching, and I'll see you next time.